Okay, good afternoon. I'm Cindy Ma with Houlihan Lokey. Our conversation today is actually going to be quite broad, covering how macroeconomic and geopolitical trends are shaping the diverse opportunity set in private credit, the implication of technological developments, and how realization fits in this broader context. I think we're very lucky today is because we actually have a panel of titans. The reason I said that is each one of them could be a keynote speaker by themselves for this 30-minute sessions. So with that, I'm going to cut all the small talk because we need to go right into the substance. Again, it's I think this is the first time this panel of titans will be restricted by the length of the response because I'm a math person. We got 30 minutes. I will only take 2 minutes. So we got 28 minutes left. Each of them will have 7 minutes. I'm going to let them decide how they spend that 7 minutes. So, okay, with that is is the first question is not all private credit is created equal, right? For the purpose of setting the stage for the audience today, how would you define private credit in the context of your firm's history, fund strategy, and areas of expertise? So for the first question, let's go alphabetical. We start with Brian, and then Paul, Steve, Tack.
Thank you. Private credit, we are a core distressed investor. So from the beginning, we've always looked at credit curation as the most important thing and being a solutions provider. And so looking at our broad syndicated loan business through our CLO, long-short credit business, opportunistic credit, and that's really encompasses private credit. So public or private, we're indifferent because many public credit situations going to financial difficulties, there comes out of that on the back end many times a private credit security that we would own. And we'll look at these opportunities throughout credit, throughout the world, up and down capital structure. And now it might be in real estate credit, it might be asset-based lending, it might be structured credit. However, it's always looking at where can we look at the downside valuation and get comfortable there.
Hi. So here's what we are. We are indeed a private credit manager, but here's what we're not. We're not direct lenders. He's a direct lender. He's a good direct lender. That's not who we are. What we do is we team up with banks. We team up with banks in our co-lending. We team up with our banks in our SRT, or we're one of the founders, indeed, of the credit relief capital arbitrage. We team up with banks in our credit derivatives business, and we team up with our banks in structured credit. Why do we do that? Banks are not bad people. We don't see the need to disintermediate them. They're just regulated differently. Banks can bring something to the trade. We can bring something to the trade. And so the little position, the little corner of the market that we possess is team up with the banks, get an arbitrage by working with the banks, and that's how we deliver on private credit.
Thank you, and thanks for having us. It's a great question because I think the term private credit gets conflated with middle market lending too often, so defining it is important. Private credit broadly is a $50 trillion market. Most of it is IG. A lot of us here are spending time on non-investment grade. But for Sound Point, private credit comes in 4 flavors. We have core middle market lending, which is sponsor-backed lending, companies with 20 to call it 70 million of EBITDA. We have our specialty finance business, which is really buying packages of consumer loans from LendingTree and Lending Club and fintech companies and originators that are competing with the banks. We have a capital solutions business where the job is to go plug a hole in a balance sheet, usually for 2 or 3 years. It's a mid-teens type return. And then we have our commercial real estate credit business where we're originating transitional mortgages. So we do performing credit and private credit. We think about the private credit business as our manufacturing business. We originate, structure, document, underwrite, monitor.
Thanks. So we're the vanilla player, I think, in the ice cream shop here today. We do direct lending, private credit, middle market focused. So think of the world as first, second, third generation companies that are being bought and sold by private equity firms. We finance the private equity firms buying US-based companies. We've got 520 companies in our portfolio. We look at 2,000 transactions a year, and we'll finance about 100. So we've been doing this 25 years. We do the same thing year in, year out, about 100 deals a year. We put about $10 billion in the ground. And middle market private credit's been a business that the banks used to do years ago when I started 25 years ago in this business. And because of regulatory capital challenges, most of that business is done today outside of the regulated financial system by asset management firms. We will do performing credit. We'll do alternative credit. We'll do real estate credit. We'll do sponsor finance credit. We'll do non-sponsor credit. But most of our transactions are transactions. They're buyout, change of control transactions. They're not trades. We want continuing, ongoing relationships with our companies and our private equity firm clients.
Great. Let's go to look at the market dynamics topic. The question is, how is the global macroeconomic and geopolitical environment impacting the opportunity set in private credit? And each of our panelists here sits actually in the different corners of the private credit market. So from your perspective, where are the most attractive opportunity emerging? So this time we start with Steve and go down to Ted, Paul, and Brian.
Yeah. Well, just to your first point, I do think the most important trend in private credit continues to be the tidal wave of capital that's moving off bank balance sheets to our funds or the funds or balance sheets of our customers. And I think if, broadly speaking, if regulators or internal risk managers at banks are concerned about macroeconomic issues, then that only benefits us. It creates more opportunity for us. And there are probably people that are sitting in the audience who wonder if there's a bubble in private credit because it does feel like there's been growth. And I will say that when you think about how we manage private credit, we tend to manage it in vehicles with either no leverage or lightly levered. Whereas before the great financial crisis, banks held the preponderance of credit at 20 or 25 times leverage. So in terms of systemic risk, I think, you didn't ask the question, but I do think that the trend is a positive trend, broadly speaking. And I do think to the extent that LPs and investors are concerned about geopolitics or the effect of geopolitics or macroeconomic issues, or they're concerned that we're moving towards a credit cycle or a default cycle, where we are seeing interest is in ABL and accounts receivable. Why? Because it has low correlation or no correlation to more cash flow based lending. So that's where we see investors leaning in. We've been doing accounts receivable and asset backed in our capital solutions business for 10 years now. And it was a quiet, interesting, workman-like product for years. And now it's the sexiest, or one of the sexiest private credit products.
It's an interesting time. We've got the highest PE ratio today in the S&P that I can ever remember. It's almost 30 times today. We've got the highest non-standard auto loan defaults. We've got the highest credit card consumer defaults and the highest subprime mortgage defaults. So we really have a dual economic situation in the U.S. We have very healthy corporate S&P, the stock market, but the consumer is not good. We're seeing very high inflation and we're seeing high unemployment. Normally, when the stock market is high and trading very well, the economy is on a straight line up. I'm concerned that the consumer is not on a line up, but on a line down. So as a lender, we've got to be cognizant of that, and we have to be very focused on where we want to invest. So as a company, our 520 companies are spread across mostly business services, software, technology, healthcare. Where they're not involved is in consumer goods products, hospitality, restaurants, and things that are very cyclical in nature. And anytime we go into credit cycles, the consumer generally leads into a down cycle and leads us out of a down cycle. So we're very heightened aware today of the potential risks. Now, It's been masked somewhat by interest rates. Short-term interest rates keep coming down. And I think we're going to see it again here tomorrow, where the US Fed reduces interest rates by another 25 basis points. The interesting thing is that long-term rates aren't coming down. Long-term rates are holding. So that tells you that we're very concerned about deficits, we're concerned about unemployment, we're concerned about inflation. So I think that we're going into a time period where there's going to be some volatility, and it's going to be good for private credit players, because private credit players tend to be niche players that embrace volatility and that can underwrite volatility irrespective of which side of the ice cream we focus on. We are all very focused on strong underwriting and focused on collecting our debt. As the last panel said, with asset-based lending, you have to be very focused on the assets. If you take your eyes off the assets, you end up in a First Brands or a Tricolor situation where you're greatly at risk. So today, it's all about underwriting. Focus on managers that have the best underwriting infrastructure, and you will win today in private credit.
Well, your question is always an important question, but I think it's even more important right now. The fundamental question we ask ourselves is, where do we want to lend? Where's the macro the best? And what kind of lending do we want to do? Different lending suits different environments. Orchard Global is truly global, so we can invest anywhere. Big operations in Asia, we have presence here, our biggest office is in London, and our headquarters is in Houston, Texas. Now, back when we were teaming up with Ted 10 years ago, the US was a great place to lend. Actually, and I gotta, thanks for setting me up, but for all the reasons that Ted just said, the US, great economy, may be great for private equity or equity or VC or Magnificent Seven, but as lenders, we don't have a lot of conviction in the US right now. We have a lot of conviction as lenders into Europe. Not because Europe is solving all their problems. In fact, because we think that Europe has so many demographic, regulatory, energy cost headwinds, that's exactly when we want to be lending. We actually think in single B, double B kind of credit risk, which Ted does also for a living. We think that you can get 125 to 150 basis points more in Europe than in the US for the same risk. Why is that? The US has a BDC market. The US has a more developed ABS market, ABL market, CLO market. They have, stronger banks, more competition. Europe, you have Brexit, you have deglobalization, you didn't have capital markets union, you didn't have banking union. So where do we want to invest? Europe. What kind of lending do we want to do? We've done in the past sponsored lending, LBOs, buyouts, that a lot of the other people in this panel do, and that's great. Right now, we're not doing that. Because of those high PEs, we think that's a little bit too leveraged. We like to be, in fact, I probably should have sat in the last panel, much more asset-based, much more car parks, airports, aircraft engines, pipelines, frac sand, that type of thing. So right now, the answer to your question is geopolitically and macro in Europe, and less leverage finance and more asset-based.
The word we use today is dispersion. So if you look at the IG and high yield market, they're at all-time tight levels or decades tight levels. As mentioned earlier, you have a steep yield curve, so duration is going to be more costly. You look at the secular issue from 2020 and the rates have gone up, and private equity and other companies that borrowed with floating rate debt, they're now suffering because they haven't been able to grow. The inflation for some is causing some margin erosion. And so looking at the K-shaped recovery, as was mentioned, that is giving a lot of companies issues. So you have a lot of this driven by liquidity, by the Magnificent Seven, very high PE ratios, and that obfuscates some of the underlying issues. There's a lot of companies that are PIK. There's many of those PIK bonds that are private credit. You look at the broader syndicated loan market, we have the CLO business, we see a window into those that are struggling. and they can't write a check. So we're able to go in what we call liability management exercises and write a check to a private equity sponsors companies that has a private credit existing, where there might be either weak covenants for a broad syndicated loan or an ability to come in and layer on a very senior level and get paid an extra 300-400 basis points on what would be traditional private credit. And so going on top of the capital structure, which is important as we go into this credit cycle. There's been as many rate lowerings has gone around the world than back in the GFC. However, that steep yield curve, I think, is worrying about the inflationary pressures, which is causing that margin erosion. Now, there's still the reshoring, there's still the AI infrastructure, and all these trends that are going on, which is going to be $3, $4, $5 trillion. That's going to be problematic. Now, the banks, Wells Fargo had their asset cap removed. So the banks in 2013 were basically told, hey, 6 times leverage you can't do, which really created the private credit market as we know today. That's been recently reversed by the Fed and the other regulators and giving the banks the ability to come back into that market. Wells Fargo has $1 trillion that they want to extend. You saw them just write a $30 billion check for the Netflix transaction. And so I think they'll be interesting as that new flood of capital comes in. But I think they've gotten used to a better originate distribute model. Now, the U.S. is 30% bank dominated. Places like Middle East, it's 95+%. And so I think there'll be opportunities in places like the Middle East. I think there's opportunities, obviously, in Europe, but fragmented. And certainly as we're global, I think Asia is difficult. You know, you have a couple of the markets which we've been able to be successful in. But the U.S., given the amount of low DPI and the need for liquidity, and particularly from a restructuring opportunistic credit standpoint, we see this trend that will continue for some time as we go into this new cyclical transformation.
Well, given the quality of responses we're hearing, we may have to cut some questions. But let's go to the next questions. As private credit continues to grow, and how do you ensure that scale doesn't come at the expense of underwriting diligence and credit quality, especially in a more volatile and increasingly competitive credit environment? Why don't we start with Steve, and then we go down Ted, and Paul, and Brian.
Yeah, I think, look, part of the ethos of Soundpoint is it's better to have more ideas than capital. And especially in manufacturing businesses, direct lending, accounts receivable, ABL, et cetera, you need to look, and Ted talked about this earlier, you need to have a lot of reps. You need to put things at the top of the funnel. If you don't have a lot of things to put at the top of the funnel, you may be more likely to end up executing on a transaction that isn't good for your LP. So more ideas, less capital, that's hugely important. And how do you ensure that? Well, part of it is showing the restraint, being long-term greedy. We're about to do a final close for our Strategic Capital Fund 3, which is an accounts receivable fund. And we imposed a hard cap of $1.5 billion and could have raised 3 times that much. And I do think as investors, you need to understand the managers with whom you work and make sure that they are being thoughtful about your capital as opposed to being long-term greedy as opposed to being short-term greedy.
You know, Cindy, that's the best question that you could possibly ask, because that's what keeps me up at night. You know, what could go wrong? And in a market where we've seen a 20% growth rate in capital entering into the private asset segment, private lending has got a lot of capital. The only thing worse right now is private equity. There's $1.4 trillion of dry powder sitting in private equity asset managers waiting to deploy. Now, I have a lot of friends that are GPs in private equity. Assume they're not going to return that money to their LPs. So assume they're going to find a way to deploy that capital. So if you assume that for every dollar of private equity that gets deployed, there's a dollar of private credit that gets deployed in some 50-50 ratio. We don't have nearly enough dry powder in private credit to deploy to support the amount of dry powder that's going to be invested over the next 3 years in private equity. So if you assume today that the private credit marketplace is about a $1.5 trillion market, we're going to take that $1.5 trillion market to about $3 trillion in the next 3 or 4 years. So the key, as we just heard, is find the right opportunities, make sure you've got a deep enough top of the funnel flow. We look at 2,000 investment opportunities a year, 2,000, and we do about 100. That's less than 5%. Now, that's because the US is a large, diversified market where there's probably 7,000 transactions a year. Europe is about 20% the size of the US, and that's the next largest market in the world. So for us, we've got a very large infrastructure, 350 employees, about 150 investment professionals, and it's about underwriting. It goes back to the first discussion we had. Underwriting, credit, portfolio management, portfolio monitoring. We have to stay on top of the credits. Covenants are crucial. Today, 80% of the market is covenant light in transactions because the syndicated loan market has bumped up against private credit at the upper end of the market, making it one big similar market. So we like to play in the lower part of the market where there's covenants. Whether you're lending to a company at the lower end of the market or the upper end of the market, the winners are going to be the asset management firms that can monitor the credits and then manage the defaults.
Yeah, Ted is right. Private credit is growing, and it's whenever there's a market that's growing from $1.5 trillion to $2 or $3 trillion, or by 100%, you got to ask the question: is how much is too much? It's absolutely the right question to ask, especially since, as we all agree, we're getting in, especially in the U.S., into a trickier part of the credit market. But perspective is also important. The top 20 banks control over 100 trillion in lending assets. So, I was a regulator. I started at the Fed. I was a bank regulator, albeit a junior one. And in fact, the last AMA conference I spoke at, we were at the IMF, where the SEC was there. And what I pointed out to them is, yes, it is true, it's growing, but if we're going from 1.5% of the market to 3% of the market, let's not overstate. There's still a lot more to grow. Now, that's why we work with banks. So, that said, as everybody else has said, you need to be careful, especially now. Number one, it's why we don't do leverage finance right now. Number two, we turn down about 95 to 97% of the deals that we see. But because we, as I said earlier, team up with banks, every loan that we make, or almost every loan that we make, has been through our process, and we have a very stringent process, 95%, 97% rejection rate, but then it also has to go through the banks. And because we know the banks so well, because we are also their primary capital provider, we also know which banks are good, which are bad, and which are ugly. So we work with the best banks and their best origination and their best credit departments. We don't rubber stamp that. We have our own separate ones. And we actually did a deal way back when where Ted's team would underwrite and our team would underwrite. And then my favorite thing to do is watching my credit team disagree with his credit team. And it was a great partnership, worked out well for us. But that's the way that you lend in a market that is, as Ted said, more risky than not.
I think it's always incumbent upon the lender, the investor, to do their work. I think, as it was said earlier, we want to have more opportunities than capital. We've always operated in markets. That's why we are global. That's why we're big enough to be relevant in all the different verticals and markets we operate in, but not too big where we have to do everything. One of the big, large investors goes around and tells everyone, yeah, we see everything. And the counter to that is, yes, but you have to do everything too. And so I think that's the most important thing from our perspective is right-sizing your capital to be able to take advantage of the opportunities, but able to be very selective, as has been said here. I think, again, given that perspective from a bankruptcy distressed investor, that's our core competency. Always what can go wrong, always looking at seeing so many different restructurings where investors, bondholders have been screwed or bank lenders have been screwed. What are the different covenants? So we have a very seasoned and deep bench on our legal team, which is able to go through, and this is not something you can use ChatGPT to figure out. It is something that you need decades of experience to understand, the different ways that companies can maneuver, or sponsors can maneuver around their creditors. And so that's sort of how we look at things. Want to make sure that we're always able to be on our front foot in terms of pricing and to be able to solutions provider. I think if you're a solutions provider, many times we'll reverse into companies that we see them going into trouble. And that has been an interesting solution, because then we're not waiting to see what's shown us. Many times if you get seen something, it's kind of not the great opportunity. However, if you're able to reverse inquiry in, those have been our best investments.
Well, as I watch the clock, my mind keep recalibrating the outline of questions. What should I ask? What should I not ask? So we only have 2 minutes left. What I would like to do is each of you have 30 seconds to cover things that you have not covered. This time I will really have to cut you off within hopefully 25 seconds. Start with Steve.
Yeah, so everyone wants to talk about AI, and we don't, none of the people on this panel, except for perhaps in our PA, are buying NVIDIA stock. And so I think about how AI can affect our business. What AI does extremely well is they do the drudgery that human beings don't like to do. They do it in a better way. So we've applied AI to our middle back office, IR, accounting, et cetera. We also use something called Hebia to help us write memos, do models, help us streamline and focus our people on using their judgment as opposed to doing drudgery.
Okay, now each of you only have 20 seconds because it takes more time. So
Too much
Tess.
time?
Sorry, guys.
I'm going to say 2 words: data centers. Everyone talks about data centers. The last guy up here talked about how much data centers he's doing. There's going to be a few winners and a lot of losers in data centers. Be careful. The world doesn't have enough power. We don't have enough water. Data centers are going to be a disappointment to many investors, and I'm concerned the retail investors are going to be the ones that get hit the worst. So be careful.
20 seconds.
Yeah, 2 things. Now is the time to be a conservative lender. Ask for more covenants, take less spread if you need to, but really protect yourself, number 1. Number 2, now is the time to be long volatility. In our derivatives funds, we're long vol. You want to be long vol. What I can guarantee you is when we meet next year and the year after that, we are entering a much more volatile period. So be defensive.
So you're over. So if you think about the liquidity is the most important thing. That's what we focus on. Liquidity in the framework. You look at DPIs lowered. You look at the fact that there's many companies that are struggling with liquidity. On the data center, we have a non-evaporative cooling, liquid cooling, so it's no water issues. Certainly AI ecosystem, $3, $4, $5 trillion it's going to crowd out a lot of the borrowers. So that is something to be mindful, but certainly appreciate all the comments.
Well, with the panel of titans, I failed the job as a moderator because they basically say you need to end on time. I know we ran on deficit, and sorry about that. I know Amos not going to invite me back, but thank you, everybody.
Thank you.